Introduction and important definitions. In first topic, we're going to understand how the taxes in a country are broadly bifurcated. Now, the taxes in India as well as many countries are bifurcated in two types. One is a direct tax and one is indirect tax. In case of direct taxes like income tax, wealth tax, the person who is paying the tax liability will actually bear the burden of the taxes. On the other hand, indirect tax like service tax, excise, custom duty, VAT, CST, the person will collect taxes from another person, or you can say the customers, and then the same person, that is businessman, will deposit these taxes with the tax authorities. Now, in short, the person who is paying the tax liability is not bearing the burden. With this, we're going to learn all the other important concepts in case of direct tax and indirect tax in this first topic. Also, we're going to understand the other important concepts and components of income tax laws. We're going to understand the concept like what is the previous year, what is assessment year, what do you mean by income, who is a person, who is assessee, which receipts are considered as capital receipts and which are considered as revenue receipts. So all those points we're going to understand in this particular topic. In income tax, you will understand that the total income of the person is bifurcated in 5 different heads. That is salary, house property, business profession, capital gains and other sources. Now, after considering all these heads of income, exactly how to calculate total income, how to get the deductions and how to calculate the taxable income, and finally how to compute this tax liability for different kinds of people, that we're going to understand in the first topic, that is introduction and important definitions. Introduction. As we have discussed that government imposes two types of taxes mainly. One is a direct tax and one is indirect tax. In case of direct tax, what happens is the person who is paying the tax liability will actually bear the burden. For example, Mr. Santosh, who is generating income during the previous year 2015-2016, will actually bear the burden of the taxes. That means Santosh cannot transfer his burden to pay taxes to someone else. So in case of taxes like income tax, wealth tax, what happens is the person who is paying the tax liability will actually bear the burden of the taxes. On the contrary, indirect taxes are paid by one person and which are collected by another person, which includes service tax, excise, custom, VAT, CST. To give you an example, let us say ABC Limited is rendering services to XYZ Limited. So in this case, when ABC Limited is providing service to XYZ Limited, what ABC will do is ABC will charge service tax to XYZ, and once the taxes are collected by ABC from the company XYZ, then these taxes will be deposited with the service tax authorities. So here what will happen is the person who is paying the taxes is ABC Limited, but it is collected from the XYZ Limited. In short, ABC Limited has not borne the burden of payment of tax liability. So that is the concept of indirect tax. As far as income tax is concerned, the major source of revenue for Indian government is nothing but the income tax. And that's the reason why the income tax is always as important for Indian government as a source of revenue. The responsibility of collection of this income tax is lying with the central government. That means state government has no say in collection of the income tax, but the central government will formulate the rules and regulations with the help of the Basic Income Tax Act and with the help of amendments in the original act with the help of different finance acts. Now, how these provisions are made, how these provisions are implemented, that we'll see one by one. The Income Tax Act came into present with effect from 1st April 1962. That means the Finance Act was first applicable for financial year 1961-62, that is assessment year 1960 to 63, and every year it got amended with the help of the Finance Act, and therefore in the month of February the budget is presented in the Parliament. Now that budget will give the information about the particular year's income computation, and therefore every year the Income Tax Act gets amended with the help of the amendment in the budget, that is the Finance Act. Now the Finance Bill contains various amendments such as the rates of income tax, the rates of other taxes like surcharge and education cess, and various other provisions in connection with application and implementation of income tax rules. Now when this Finance Bill is approved by both the houses of Parliament and receives the assent of the President, then it becomes the Finance Act. And once a Finance Bill is becoming Finance Act, then it is applicable for a particular financial year. The Income Tax Act contains the provisions for determination of taxable income, determination of tax liability, procedure for assessment, appeal, penalty, and prosecution. That means basically income tax gives all the provisions starting from how a person, that is individual, HUF, AOP, BOI, company, partnership firm, that means every category of person, how they can determine their income. Now once that income is determined, how to compute their tax liability, because based on the nature of the person, the computation method is changed. So we will learn that method of computation of tax liability in this particular chapter, but this method changes for every person, and therefore how to determine the tax liability, and once the tax liability is determined, the person is required to pay off the tax liability and do certain compliance procedures. Now which includes submission of return of income, that means income tax return forms are submitted to the tax department, and once that form is submitted, then the assessing officers will determine whether the income or the tax liability determined by the person is correct. If it is not correct, then what is the course of action which can be taken by the assessing officers, or you can say income tax officers. And after that, if the assessee is not satisfied with the order, then what should be the remedy, or what should be the course of action which can be taken by the person. So for that purpose, the person can file appeal against the income tax department. So the provisions in connection with appeal and in connection with the penalties and prosecution in case of non-compliance, so all these provisions are given in Income Tax Act. Now let us understand few income tax definitions which are very important for understanding the general calculation of income tax. First, when I say income tax, it is necessary to define what is income. Now section 2 subsection 24 defines the term income. Now the term income means and includes first profits and gains, that is profit, or you can say the gain arised from the business and professional activity. Secondly, the dividend income. Now once a company is declaring dividend to its equity or preference shareholders, that will also be considered as income. Next is the voluntary contributions. Now whether these contributions are received by a trust which is wholly carrying on its operation for charitable or religious purposes, or a scientific research institution, or a fund or trust which is established for charitable purposes and notified under section 10 subsection 23c clause 4 or clause 5, or any university or other educational institution, or by any hospital referred to in section 1023c clause 2ad, 6, 2ae and 4a, or finally an electoral trust. That means if that voluntary contribution is received by any of these persons, then still it will be considered as an income. Next is the value of any perquisite or profit in lieu of salary taxable. That means whenever a person receives certain extra benefits from the employer during the course of his job, then whatever are the extra benefits received will be considered as or will be treated as a perquisite, which is considered as income of the person. Next is any special allowance or benefit specially granted to the assessee to meet expenses wholly, necessarily and exclusively for the performance of his duties of an office or employment of profit. Then city compensatory allowance or dearness allowance. That means certain allowances are given in order to maintain the level of expenses increasing. That is, in order to maintain the level of inflation in the market. So whether that is a dearness allowance, or if you are residing in a particular city, then city compensatory allowance is given. So even that is considered as income. Next is any other benefit or perquisite to a director of the company. Now this will also be considered as income of the person. Next point is any benefit or perquisite to a representative assessee. That means in certain cases the assessee will not get the benefits directly, but the benefits will be received by a representative person. Next is any sum chargeable under section 28, section 41 and section 59. When we talk about business, profession and other sources, we will touch upon these sections in detail. Next is capital gains. Whenever a person transfers a capital asset and certain benefit or profit arises from such transaction, then it is treated as a capital gain. So even that is considered as income. Next is insurance profit. Now, whenever insurance company settles a claim, then some amount is flowing from insurance company to the person who has taken the insurance policy. And therefore whatever are the insurance benefit or profits which have been received by the person, even that is considered as income. But remember here, when the person receives the LIC or person receives the amount from insurance company after the death of the person by his family members, then such income will not be considered as taxable. Next is banking income of the cooperative society. Now this has been specifically kept because earlier the income of cooperative banks was exempt from taxes, and therefore they have made this point very clear that if it is a banking income of a cooperative society, then it will become income. Next is winning from lottery. Now whenever a person generates income in the nature of casual income, it may be in the nature of lottery, crossword, puzzles or anything else, so that income will be considered as a taxable income. Next is employees' contribution towards the provident fund. Even that would be considered as the income of the person. Next is amount received under a keyman insurance policy. Next, amount received for not carrying out any activity. Now in certain cases the person receives the amount for not conducting a business in a particular location, or for not carrying out any professional activity or any other allied activity in order to safeguard the business of another person. In that case, whatever income is received by the person it will be treated as the income of the person. Next is gift received for an amount exceeding rupees 50,000. That means if a person is receiving gift from a non-relative and the amount of gift crosses 50,000, then such gift is also taxable. Next is consideration received for issue of shares. So whatever amount is received in connection with that, so even that would be considered as taxable, subject to certain terms and conditions. Let us understand the concept of income. Now we have already seen that income is bifurcated in 5 different categories: salary, house property, business, profession, capital gains and other sources. But whenever we calculate income, certain basic fundamental questions has to be answered as to which income is to be taxable and which income is not taxable. And for that purpose, income tax has clarified certain issues, which are as under. Generally, the question arises whether the income received in cash or in kind, which income exactly should be considered. Income tax simply says that whether you receive the amount in cash, cash means it may include bank or check payment also. But if you are receiving payment in cash, that means check payment, cash payment, as well as income received in kind. That means suppose Mr. A is rendering services and he is getting the remuneration not in cash but in the form of gold chain. Even that income is taxable. So whether you receive the income in cash or in kind, both will be considered as taxable. The next important question is whether it should be taxable on due basis or on receipt basis. Now this question is answered by Income Tax Department considering the heads of income. That means every head of income there are certain rules and regulations. When it talks about salary, it is taxable on due or received, whichever is earlier basis. As far as business and profession is concerned, income tax says you can take a decision well in advance whether you have to tax the income on due basis or on receipt basis. Once you follow a particular method, then the income will be computed according to that method. As far as other sources are concerned, again it will be taxable either on receipt basis or due basis. The stand has to be confirmed by the assessee and it should continue. The next question, whether illegal income should be taxable. Now anyone can say that legal income should be taxable, but what about illegal income? Now illegal income in the form of bribe, in the form of theft, any income which is not a legal income should also be considered as taxable income. Because if illegal income is not taxable, then it is an indication that any person can disclose a wrong or false income and thereby paying less taxes. And for that purpose, income tax says whether it is legal or illegal, both income should be taxable. Next is temporary and permanent source of income. Now it's not necessary that the person should have a permanent source of income. Even if the income is received in the form of a temporary source, still that should be considered as taxable income. For example, a person who is chartered accountant is participating in one singing competition and he is winning one award. Now that income should be considered as taxable because he is getting income from particular event. Now this income may be a temporary source, but still it should be taxable because income tax is regular as well as irregular source of income should be taxable. Next is whether lump sum amount received should be taxable or the amount received in installment should be taxable. Now here the income tax says whenever you generate the income, it should be taxable. Now whether you receive the amount immediately or in installment, it does not make any difference. It should be considered as income. Next is gifts. Now as far as gifts are concerned, gift up to rupees 50,000 are exempt and gift exceeding 50,000 will become taxable. But gift from relatives would be considered as totally exempted from the tax liability. Now there are so many other provisions in connection with gift, but we will talk about them when we will come to the head income from other sources. Lastly, revenue or capital receipt. Now this question is easily answered by tax department. Tax department says whenever it is a revenue receipt, it should always be taxable. Now whenever it is a salary income, house property, other sources, whatever, when the income is in the form of revenue nature, it should be taxable. Now what is exactly revenue nature and what is exactly capital nature, that we will discuss. But for the time being, understand that revenue receipt should become taxable always, and as far as capital receipts are concerned, these become taxable only if the income is considered as taxable under the head capital gains. That means if you are getting any capital receipt which is not in the form of revenue receipt, then it should be considered as exempted from the tax liability. but practically speaking, this kind of situation is very unlikely to occur. Next is we have to understand what is capital receipt and what is revenue receipt. Now here when we say capital receipt, it means that when a person receives the payment in connection with a capital asset. That means whenever a person transfers the asset, or if the person is giving the amount in terms of damages for a capital asset, or any similar nature of transaction wherein you are going to pay the amount towards the capital or towards the incorporation or towards the expansion plan of the business. Now here an amount which is referred to as fixed capital is a capital receipt, where a receipt referable to circulating capital would be a revenue receipt. That means if you are getting any amount referred to as fixed capital will be capital receipt, and other receipts will be considered as revenue receipt. Now while the latter is chargeable to tax, the former is not subject to income tax unless otherwise the provisions are expressly provided. Now in this connection we have to understand certain important points. First is taxable income in connection with the annuities. Now as far as income from annuity is concerned, such income will be taxable when it is actually been received. Next is taxable income vis-a-vis compensation. Now whenever a person is paying the income in the form of salary, so that should be definitely a salary income. But if the person is injured during the office hours and the company is paying him some compensation, then the question arises whether it should be taxable or not. Now income tax is whenever that amount is derived from the employer, then it should be considered as taxable income. Next is taxable income vis-a-vis subsidies and grants. Now here what you have to remember is when a person receives grant or subsidy from the government, it should be considered as a part of income. Now if the grant is for regular activity of expenses or of regular nature, then that receipt should be directly considered as income. But when the grant is towards a capital asset, then according to the accounting standard we have to formulate as to whether that subsidy or grant is to be considered as a balance sheet item, or it should be adjusted against the price of the asset. Next is taxable income vis-a-vis debentures. Now as far as debentures are concerned, the interest on such debentures is taxable. Now when a company issues debentures, definitely that amount received towards debenture is not considered as a revenue receipt, it should be considered as a capital receipt. Therefore the amount collected on issue of debentures is not taxable, but whenever a person receives interest on such debentures, then it becomes taxable. Next is taxable income vis-a-vis royalties. Now whenever a person gets the income in the form of royalty, then such amount should be considered as taxable, because the royalty may be in connection with a book or in connection with certain intangible asset. And lastly, taxable income vis-a-vis devaluation in the foreign currency. Now certain cases there are fluctuations in the foreign country currency, and therefore the price fluctuates, so there the price changes, and such devaluation in the foreign currency would be adjusted against profit and loss expenses and would not be considered while computing the income of the person. Let us continue with some other definitions. Definition of previous year. Now section 3 defines the previous year. As per this section, it means the financial year immediately preceding the assessment year is nothing but the previous year. In short, whenever a person is generating the income, that particular year would be treated as a previous year. For example, when a person is generating income from 1st April 2015 to 31st March 2016, so this year, that is 2015-2016, would be considered as the previous year in which the person has generated the income. The next definition is definition of assessment year, now which is defined in section 2 subsection 9. It means a period of 12 months commencing from the 1st April of every year. Now here we have to remember one very important point, that previous year would always end and after that the assessment year would start. For example, when we talk about financial year 2015-2016, it will end on 31st March 2016. Now the assessment year would immediately start on 1st April 2016 and it will end on 31st March 2017. Now here we have to segregate between the newly started up companies and the existing SSCs. Whenever a company is incorporating in the first year, or whenever any new entity is coming into existence, then the previous year would start from the date of its incorporation and it will end on the 31st of March. For example, if ABC Limited is incorporated on 10th June 2015, so its previous year would start from 10th June 2015 till 31st of March 2016. That means the year would start from the day on which the company got incorporated or company came into existence. Now the assessment year would be a full year immediately after completion of previous year. So my assessment year would be 2016-2017. With this, you will observe that previous year may or may not be a complete year, but assessment year is always a period of 12 months which commences after completion of previous year. Next important definition which we need to check is the definition of person. This is defined in section 2 subsection 31. The definition of person is an inclusive definition. As per this definition, a person will include the following. First one, individual. So all the individual assessees, that means all male female assessees would be treated as an individual person. As far as HUF is concerned, the HUF is also will be considered as a separate person. Now HUF means what? It means when all the persons linearly descendant from a common ancestors, then such group of people will be termed as HUF. Now here there are two schools or systems followed in India. One is Dayabhaga and second one is Mitakshara. Income tax doesn't bifurcate between Dayabhaga and Mitakshara. Both will be treated as HUF. Next is association of persons or body of individuals. Now it means when group of people come together with a common motive which may or may not be a profit motive. In that situation, the activities undertaken by them would be treated as activities undertaken by association of persons or body of individuals. But then what is the exact difference between the association of persons and body of individuals? Now when only individuals are setting up or carrying on certain activities, then it will be considered as body of individuals. But when group of individuals work along with the different category of person such as partnership firm or a company, then all of them working together would be treated as association of persons. Next person is partnership firm. Now partnership firm includes two or more partners who are coming together and entering into an agreement through a partnership deed will be termed as the partnership firm. Next is local authority. So any municipal committee, district body of port commissioner authorized by the government with the control or management of the municipal or local fund, local authority is taxable for the business which is carried on by it. So that will be considered as a local authority. Next is a company. Now company is defined under section 2 subsection 17, which includes Indian as well as foreign companies. So we are concentrating on both types of companies, Indian as well as foreign. Next is artificial juridical person. Now all other persons not falling in any of the above categories will fall here. For example, deity or idols. So Lord Balaji or Lord Siddhivinayak. So any lord will be treated as an artificial person, and the amount of donations or contributions received on behalf of such god would be treated as the artificial juridical person. Now university is also another artificial juridical person which doesn't fall in any of the above category. The definition of an assessee, which is given under section 2 subsection 7. Assessee means a person by whom any tax or any other sum of money is payable under the Income Tax Act, and it also includes every person in respect of whom any proceedings has been initiated in connection with assessment of the income of the person. That means here Income Tax Department wants to consider a person who is paying the taxes as an assessee, as well as the person against whom any proceedings have been initiated will also be treated as an assessee. Further, income tax says that a person will become assessee when he becomes assessable in respect of income of such other person, and in such cases also he may be considered as an assessee. This happens peculiarly in the case of a clubbing of income, wherein a person is transferring income in order to avoid tax liability. And in that connection, income tax says that if you are assessable for the income of some other person, then such person will be treated as an assessee. Lastly, every person who is deemed to be an assessee or assessee in default under any provisions of this act. That means here income tax also wants to cover all the other persons who are making any default or who are liable for any non-compliance which is in connection with income tax department will also be treated as an assessee. Now these points are included by income tax department so that later on income tax department can take action against those persons. Next is assessment. This is defined in section 2 subsection 8. This is the procedure by which the income of the assessee is determined by the assessing officer. It may be by way of normal assessment or by way of reassessment of the income which is previously assessed. Now in India there is a concept of self-assessment of the income. That means the person himself has to disclose what is his total income during the year. And based on such income, the income tax department collects the taxes from the assessee. Now, it may happen that the person who is declaring the income will not declare the correct or the appropriate information, and therefore income tax also considers that there has to be certain assessment procedural part which has been undertaken by the assessing officers, and therefore income tax considers a step-by-step procedure of assessment of the income of the person who is submitting the return of income. So this is known as a procedure of assessment. Computation of taxable income and tax liability. Now after learning basic definitions under Income Tax Act as to what is income, who is person, who is assessee, next very important point is determination of total income of the person. And for that purpose we have to understand certain steps which have been decided and determined by Income Tax Act. Let us understand those steps one by one. Step number 1. We have to determine the residential status of the person as per section 6 of the Act. Now this section bifurcates the residential status into broadly two categories, a resident person and a not resident person. And in case of individuals and HUF, the residential status is sub-bifurcated into ordinarily resident and non-ordinarily resident. Now this bifurcation is necessary because the taxability of income is purely based on the income generated by the person based on his residential status. And for that purpose, first step is we have to understand what is the residential status of the person. Now once that status is decided, we have to follow the second step, that is we have to calculate the income under different heads. Section 14 classifies income under 5 different heads: income from salary, income from house property, income from profits and gains of business and profession, capital gains and other sources. An employee who is getting remuneration from his employer will be treated as income from salary. When a person who is the owner of the house let out his house for a rent would be considered as his income from house property. The person who is undertaking any kind of business or any professional activity would be considered as generating income from business and profession. When a person transfers a capital asset and generates some profit or loss out of it, so then it will be considered as his income from the capital gains. And lastly, any other income which is not falling under any of the categories would be considered as income from other sources. In other sources, there are certain specific income which also be taxable. So we'll consider all the heads of income. Next step is we have to consider the net income after deductions and allowances. Now obviously when we calculate 5 heads of income, then we have to segregate the income in 5 heads, and whenever we calculate income for a particular head, then the deductions and exemption available for that particular head should be actually reduced, and then the net income from a particular head should be calculated. So we have to give the exemptions and deductions, and then we have to decide what is the net income. Next step is we have to consider the setting off of the losses and carry forward of the losses of earlier years for adjusting against the profits of the current year. Now some heads it is possible that there is a negative income. Such negative income can be adjusted against the positive income under the same head or the other head. So this adjustment would be considered as set off of the loss. Also we have to club the income whenever a person is transferring the income in the hands of another person to avoid tax liability. Now under clubbing of income provisions, we will talk about these provisions in detail as to when income will be clubbed. So we will consider both clubbing of income and set off of losses of all the heads, and then we will decide what is the gross total income of the person. After this we'll follow the next step, that is step 5, deductions admissible under section 80C to 80U. Now these are called chapter 6A deductions. These deductions are available from the gross total income, but there are certain rules and regulations for availing those deductions. So after considering those rules, whatever deduction is available will reduce that, and after giving chapter 6A deductions, whatever remains that will be considered as net income or taxable income. Now this net income, or which is popularly known as total income of the person, will be rounded off to the nearest multiple of rupee 10. For example, if a person is having income of 5 lakh 8 rupees, then his income will be rounded off to 5 lakh 10 rupees. This is known as rounding of the income under section 288A. The next step is we have to consider agricultural income of the person, if any. Now till step 5, whatever income is determined, that is considered as non-agricultural income. And if the person is also having agricultural income, then we will add back that in non-agricultural income. This will give us the total income of the assessee including agricultural income. So what we need to do is we need to calculate tax on this total income, and this tax will be compared with the tax calculated in next step. So next step, that is 7th step, is we have to calculate income tax on the net agricultural income as increased by the basic exemption of the assessee. Now it depends on the nature and age of the assessee as to what is the basic exemption limit is. As you can see that for a person less than 6 years of old, the basic exemption is 2,50,000. For senior citizen it is 3 lakh, and for very senior citizen it is 5 lakh. So based on the age you will decide what is the basic exemption limit. In this we will add the net agricultural income, and on this total income we'll also compute the tax liability. The next step is we have to take the difference between tax calculated as per step 6 and tax calculated as per step 7. Now after this, what we need to calculate is the income tax on this income which are subject to special rate of taxes. So these calculations will do it separately. Now the balance of amount of income tax left after adjusting the tax on agricultural income and basic exemption limit, then whatever amount of tax is remaining, in this we will have to add the surcharge and cess if any. Now for different categories of person, different surcharge is applicable. So according to the category of person, the surcharge would be applied, and after calculating this, whatever is the total amount, that is tax plus surcharge plus cess, that will be treated as total tax payable by the person. Now next very important point is this tax will be required to be paid by the person to tax authorities. Now this tax collection is made in different ways. One of the ways, tax deduction and collection, that is TDS and TCS. Second is advance payment of taxes. Third is self-assessment tax, that is tax determined by the assessee himself at the end of the year. And double taxation relief. That means in certain cases when the person is having income in two different countries and such income is the foreign income is charged to tax twice, then the assessee is eligible for double taxation relief. So we'll also reduce that, and then whatever amount is remaining, that may be considered as the self-assessment tax which is paid by the assessee. Then they will ask you to pay off the tax liability which is remaining after adjusting all these TDS, TCS, advance tax and self-assessment tax, and that tax is required to be paid within the specified time as per the income tax order. But remember, whenever we are calculating the net tax, it should be rounded off to the nearest multiple of rupee 10 as per section 288B. Computation of taxable income and tax liability. Now after learning basic definitions under Income Tax Act as to what is income, who is person, who is assessee, next very important point is determination of total income of the person. And for that purpose we have to understand certain steps which have been decided and determined by Income Tax Act. Let us understand those steps one by one. Step number 1. We have to determine the residential status of the person as per section 6 of the Act. Now this section bifurcates the residential status into broadly two categories, a resident person and a non-resident person. And in case of individuals and HUF, the residential status is sub-bifurcated into ordinarily resident and non-ordinarily resident. Now this bifurcation is necessary because the taxability of income is purely based on the income generated by the person based on his residential status. And for that purpose, first step is we have to understand what is the residential status of the person. Now once that status is decided, we have to follow the second step, that is we have to calculate the income under different heads. Section 14 classifies income under 5 different heads: income from salary, income from house property, income from profits and gains of business and profession, capital gains and other sources. An employee who is getting remuneration from his employer will be treated as income from salary. When a person who is the owner of the house let out his house for a rent would be considered as his income from house property. The person who is undertaking any kind of business or any professional activity would be considered as generating income from business and profession. When a person transfers a capital asset and generates some profit or loss out of it, so then it will be considered as his income from the capital gains. And lastly, any other income
income which is not falling under any of the categories would be considered as income from other sources. In other sources, there are certain specific income which also be taxable. So we'll consider all the heads of income. Next step is we have to consider the net income after deductions and allowances. Now obviously when we calculate 5 heads of income, then we have to segregate the income in 5 heads, and whenever we calculate income for a particular head, then the deductions and exemption available for that particular head should be actually reduced, and then the net income from a particular head should be calculated. So we have to give the exemptions and deductions, and then we have to decide what is the net income. Next step is we have to consider the setting off of the losses and carry forward of the losses of earlier years for adjusting against the profits of the current year. Now some heads it is possible that there is a negative income. Such negative income can be adjusted against the positive income under the same head or the other heads. So this adjustment would be considered as set off of the losses. Also we have to club the income whenever a person is transferring the income in the hands of another person to avoid tax liability. Now under clubbing of income provisions, we will talk about these provisions in detail as to when income will be clubbed. So we will consider both clubbing of income and set off of losses of all the heads, and then we will decide what is the gross total income of the person. After this we will follow the next step, that is step 5, deductions admissible under section 80C to 80U. Now these are called chapter 6A deductions. These deductions are available from the gross total income, but there are certain rules and regulations for availing those deductions. So after considering those rules, whatever deduction is available will reduce that, and after giving chapter 6A deductions, whatever remains that will be considered as net income or taxable income. Now this net income, or which is popularly known as total income of the person, will be rounded off to the nearest multiple of rupee 10. For example, if a person is having income of 5 lakh 8 rupees, then his income will be rounded off to 5 lakh 10 rupees. This is known as rounding of the income under section 288A. The next step is we have to consider agricultural income of the person, if any. Now till step 5, whatever income is determined, that is considered as non-agricultural income, and if the person is also having agricultural income, then we will add back that in non-agricultural income. This will give us the total income of the assessee including agricultural income. So what we need to do is we need to calculate tax on this total income, and this tax will be compared with the tax calculated in next step. So next step, that is 7th step, is we have to calculate income tax on the net agricultural income as increased by the basic exemption of the assessee. Now it depends on the nature and age of the assessee as to what is the basic exemption limit is. As you can see that for a person less than 60 years of old, the basic exemption is 2,50,000. For senior citizen it is 3 lakh, and for very senior citizen it is 5 lakh. So based on the age you will decide what is the basic exemption limit. In this we will add the net agricultural income, and on this total income we will also compute the tax liability. The next step is we have to take the difference between tax calculated as per step 6 and tax calculated as per step 7. Now after this, what we need to calculate is the income tax on this income which are subject to special rate of taxes. So these calculations will do it separately. Now the balance of amount of income tax left after adjusting the tax on agricultural income and basic exemption limit, then whatever amount of tax is remaining, in this we will have to add the surcharge and cess if any. Now for different categories of person, different surcharge is applicable. So according to the category of person, the surcharge would be applied, and after calculating this, whatever is the total amount, that is tax plus surcharge plus cess, that will be treated as total tax payable by the person. Now next very important point is this tax will be required to be paid by the person to tax authorities. Now this tax collection is made in different ways. One of the ways, tax deduction and collection, that is TDS and TCS. Second is advance payment of taxes. Third is self-assessment tax, that is tax determined by the assessee himself at the end of the year. And double taxation relief. That means in certain cases when the person is having income in two different countries and such income is the foreign income is charged to tax twice, then the assessee is eligible for double taxation relief. So we'll also reduce that, and then whatever amount is remaining, that may be considered as the self-assessment tax, which is paid by the assessee. Now if as per income tax authorities there is some tax which is still payable, then they will ask you to calculate then they will ask you to pay off the tax liability which is remaining after adjusting all these TDS, TCS, advance tax and self-assessment tax, and that tax is required to be paid within the specified time as per the income tax order. But remember, whenever we are calculating the net tax, it should be rounded off to the nearest multiple of rupee 10 as per section 288B. In short, if we look at the format for computation of total income and tax liability, it will look like this. We will add heads of income, that is salary plus house property. Computation of tax liability for an individual. Now after learning different steps for calculating the total income and calculating tax liability, let us understand how the exact tax computation is determined. Now this tax computation is not uniform for all categories of persons, but based on the category the income tax computation changes. Now there are certain income which is charged to tax at a special rate, that will be taxed at the rate which is specified, like long-term capital gain will be charged to tax at the rate of 20%, casual income will be taxed at the rate of 30%, short-term capital gain under section 111A will be taxed at 15%. So these are certain special rate of taxes. Other than that, the balance income of the assessee, that is income from salary, income from house property, business and profession, will be taxable at the rate which is specified by the Income Tax Act in Finance Budget 2050. That is, Finance Act 2015 prescribes the provision for the financial year 2015-2016 as to how to compute the total income and how to compute the tax liability. Now as per this, if the person is less than 60 years of old, then he will compute the tax liability in the following manner. For first 2.5 lakh it is nil, 2,50,000 to 5 lakh it is 10%, 5 lakh to 10 lakh it is 20%, and above 10 lakh it is 30%. Now here what we have to remember is, if the income of the person who is resident is less than or equal to rupees 5 lakh, then he is eligible for rebate of rupees 2,000. Now this rebate will be available from the total income of the person. But remember that this rebate is available only for a resident person whose income is up to rupees 5 lakhs. Now once you calculate this income, you will have to add education cess into that as well as surcharge, but the surcharge is applicable only if the total income of the individual exceeds rupees 1 crore. So if the income of the individual is less than 1 crore, then you will compute slab wise tax, and without adding surcharge you will add education cess. But if the income of the person exceeds rupees 1 crore, then you will add the total tax liability. On the total taxes you will add surcharge, and once you add both of them on the tax including surcharge, you will have to apply education cess, and that will be treated as the total tax liability of the individual. Now if that person is a senior citizen, that means if a resident senior citizen is of 60 years and up to 80 years, then his basic exemption limit is extended to rupees 3 lakhs. That means his tax calculation will be up to 3 lakhs. He is not required to pay any tax. 3 lakhs to 5 lakhs, the tax rate is 10%. 5 lakh to 10 lakh, it is 20%, and above 10 lakh, it is 30%. This is how we are going to compute the tax liability for the resident senior citizen person. But if the person is very senior citizen, that means if the person is of 80 years and above, then in case of such resident individual, up to 5 lakh, he is not required to pay taxes, and above 5 lakh up to 10 lakh, he is required to pay tax at the rate of 20%, and above 10 lakhs he is required to pay tax at the rate of 30%. So this is how we are going to compute the tax liability for an individual. But here one point we have to remember is that the extended exemption limit, that is of 3 lakh and 5 lakh, is applicable only for a resident person. But if the person is a not resident person, then irrespective of his age, his basic exemption limit remains 2,50,000. That means, let us say Mr. Nathan, who is 69 years of old, who is a foreign citizen. For him, the tax calculation would be up to 2,50,000 nil, 2,50,000 to 5 lakh 10%, 5 lakh to 10 lakh 20%, and above 10 lakh 30%. So this indicates that for a not resident person, the age does not matter. His tax calculation would be based on same rates as that of a person who is resident in India less than 60 years of old. After understanding the tax computation for individual, let us understand how to compute the tax liability for HUF, AOP and BOI. For HUF, that is Hindu Undivided Family Business, or for association of persons, or for body of individuals, the tax calculation remains same. That is up to 2,50,000 tax rate is nil, 2,50,000 to 5 lakh it is 10%, 5 lakh to 10 lakh it is 20%, and above 10 lakh it is 30%. Now as far as surcharge is concerned, surcharge is applicable at the rate of 12%, same that of individual, if the total income exceeds rupees 1 crore. So remember, when the income of the individual HUF, AOP or BOI exceeds rupees 1 crore, then they are required to pay surcharge at the rate of 12% on the income tax. Here we have to remember that as far as a person whose income marginally increases beyond 1 crore, in those cases what happens is their additional tax liability, that is surcharge, is more than the amount of income generated exceeding 1 crore. Then marginal relief is available because their income exceeding 1 crore is less than the overall increase in tax liability beyond the general limits, and therefore the concept of marginal relief has came into picture. Now once you calculate the tax and surcharge, then you will have to add education cess into that is at the rate of 3%. Now this education cess is bifurcated as basic education cess of 2% and secondary and higher education cess of 1%. So taken together, the total education cess is 3%. Remember, this education cess remains same for all category of people. Now let us understand the tax computation for an individual with the help of one practical question. Compute tax liability for Mr. Sunil, whose age is 42 years, whose annual income, that is taxable income, is rupees 14 lakhs. Now let us understand how to calculate the tax liability for Mr. Sunil. His age is 42 years, which indicates he is less than 60 years of old, and therefore his basic exemption limit is 2,50,000. After calculating the basic exemption limit for rest of the income, that is from 2,50,000 to 5 lakh, it will be taxed at the rate of 10%. 5 lakh to 10 lakh it will be taxed at the rate of 20%, and above 10 lakh income will be taxed at the rate of 30%. So 5 lakh minus, so for first 2.5 lakhs the tax liability is nil. From 2,50,000 to 5 lakh the tax rate is 10%. So you will take the difference between 5 lakh and 2,50,000. So 5 lakh minus 2,50,000 into 10%, so which will amount to rupees 25,000. 5 lakh to 10 lakh, that is the extra 5 lakh rupees, it will be taxed at the rate of 20%, so which is rupees 1 lakh. Above 10 lakh it is 30%, so 14 lakh minus 10 lakh, so it will be 4 lakhs. So on 4 lakhs 30%, which is 1,20,000. Once we will add all the three, that is 25,000 plus 1 lakh plus 1,20,000, total will give me 2,45,000 as the tax liability. In this will require to add surcharge if the total income exceeds 1 crore. But as you can see, the total income is just 14 lakhs and therefore the surcharge is not applicable. So on 2,40,000 without adding surcharge, we will be required to calculate the education cess. So 2,45,000 plus 0 surcharge, so that will give us the total tax of 2,45,000. On this 2,45,000 we will add education cess at the rate of 3%. So 2,45,000 into 3% will give us 7,350 rupees. So total tax liability will be 2,45,000 plus 7,350 will give us 2,52,350. So the total tax payable for Mr. Sunil for the financial year 2015-16 is 2,52,350. Now let us understand with the different example when the income of the individual exceeds 1 crore, then how the tax liability is computed. Mr. Hemant, age 53 years, whose annual income is 125 lakhs, and you are required to calculate the tax liability for Mr. Hemant. Now the tax calculation will remain same, only the difference will be the surcharge. Because his income has crossed 1 crore, he is required to pay surcharge at the rate of 12% on the tax liability. Now let us see how the tax liability is computed. For calculating taxes, first 2.5 lakhs it is nil, 2.5 lakhs to 5 lakh 10%. So on 2,50,000 10%, that is 25,000. 5 lakh to 10 lakh, that is 10 minus 5 lakh, that is on 5 lakh 20%, so that is 1 lakh. And above 10 lakh, that is 125 lakhs minus 10 lakhs, so on 115 lakhs 30%, which is rupees 34,50,000. Now once you add all the three, that is 25,000 plus 1 lakh plus 34,50,000 will give us 35,75,000 as the total tax. Now in this we are required to add surcharge at the rate of 12%. Now this is because his income has crossed 1 crore. So on 35,75,000 will apply 12%, which will give us 4,29,000 as surcharge. Then we will add total tax of 35,75,000 plus surcharge of 4,29,000, which will give us 40,04,000 as total tax including surcharge. Now on this amount we are required to add education cess at the rate of 3%. So 40,04,000 into 3%, that is 1,20,120 will be the education cess. So once we add total tax including surcharge plus education cess will give us the total tax payable for a person, which is rupees 41,24,120 rupees. This is how we will compute the income tax liability for a person whose income is exceeding rupees 1 crore. Next, we will understand how to compute the tax liability for partnership firm and local authorities. Now, as far as the firm or local authority is concerned, there is no question of slab-wise taxation, because for them it is a flat rate of tax which is 30%. That means whatever is the income of partnership firm or local authorities, that is subject to tax at the rate of 30%. Let us take an example. Suppose firm is having income of 1 lakh. Then on 1 lakh you will apply 30%, that is 30,000, plus education cess of 3%. So 30,000 plus 3%, that is 900. So 30,900 would be the total tax for the partnership firm. But remember, the firm is also subject to surcharge if the total income of the firm exceeds rupees 1 crore. Same is the case with local authority. If their income exceeds 1 crore, then surcharge is applicable at the rate of 12%. So if the income is exceeding 1 crore, then first you will apply 30% of tax, then 12% of surcharge, and finally 3% of education cess. Next is tax computation for cooperative society. Again, for cooperative society, the tax computation is slab wise. Up to 10,000, the tax rate is 10%. 10,000 to 20,000, the tax rate is 20%. And above 20,000, the tax rate is 30%. That is how the tax liability will be computed for cooperative societies. Now the rules regarding surcharge and education cess remain same here also. If the income of the cooperative society exceeds rupees 1 crore, then on total tax liability, the surcharge at the rate of 12% will be made applicable. Then you will have to add total tax and surcharge, and on that total amount we are going to compute the education cess, which is at the rate of 3%. So the final tax payable will include the basic tax plus surcharge plus education cess. So this is the total tax which will be required to be paid by the cooperative societies. Next is computation of tax liability for a company. As far as a company is concerned, the tax liability is bifurcated based on the category of company. The basic rate of tax for a domestic company, or you can say Indian company, is 30%, and the tax rate that of foreign country is 40%. But remember, the rate of surcharge is again different for Indian company, or you can say domestic company, and foreign company. For domestic company, the rate of surcharge is 7% if their income exceeds rupees 1 crore, but which is less than 10 crores. On the other hand, if the income of the company exceeds 10 crore, then the rate of surcharge will be 12%. But for a foreign company, the rate of surcharge is just 2% when the income exceeds 1 crore, but when it is less than 10 crores. And surcharge at the rate of 5% is applicable when the total income of the company exceeds 10 crores. Now this surcharge rate for foreign company is less because the basic tax rate for foreign company is high, that is 40%. Now once you add the basic tax and surcharge, then again same education cess at the rate of 3% will be made applicable. Now whether it is a domestic company or a foreign company, the rate of education cess remains same. This is how we are going to compute the tax liability for a company. Tax computation for an Indian company. Now let us take different scenarios when the income of the company is less than 1 crore, when it is between 1 to 10 crores, and when it is crossing 10 crores. So what is the exact difference between tax computation in all the three scenarios? Let us take first case, when the income of an Indian company is 50 lakhs. So on 50 lakhs you will apply tax at the rate of 30%, which is rupees 15 lakhs. Now since the income is less than 1 crore, there is no surcharge applicable. So 15 lakh plus 0 surcharge will give us total tax including surcharge of 15 lakhs. Now in this 15 lakhs we are supposed to add education cess at the rate of 3%, which is 45,000. So the total tax liability for this company will be rupees 15 lakh 45,000. Next case is a case where the income of the company is 1 crore 40 lakhs. Now in this situation the income is between 1 to 10 crores, so rate of surcharge will be 7%. Now how to compute tax? Let us see. Now on 1 lakh on 1 crore 40 lakhs, you will apply tax at the rate of 30%, which is 42 lakhs. On 42 lakhs, you will apply surcharge at the rate of 7%. So 42 lakh into 7% will give us surcharge of 2,94,000. Now once we add both of them, it will be 44,94,000. And in this we are going to add education cess at the rate of 3%, which is 1,34,820. So the total tax payable in this case will be 46,28,820 rupees. So that is the second case. Third situation, where the income of the company exceeds even 10 crores. So in third case, the income of the company is rupees 15 crores. So on 15 crores you will apply tax at the rate of 30%, which is 4 crore 50 lakhs. On this amount we will add surcharge at the rate of 12%, because the income has crossed rupees 10 crores. So on 4 crore 50 lakhs you will apply the surcharge rate at the rate of 12%, which is 4 crore 50 lakhs into 12%, which is 54,000. So the total tax including surcharge will be 4 crore 50 lakhs plus 54 lakhs, so which is 5 crore 4 lakhs. In this we will add education cess at the rate of 3%, so which will give us 15 lakh 12,000. So final tax payable will be 5 crore 4 lakh plus 15 lakh 12,000. So the total tax payable is 5 crore 19 lakh 12,000. This is how we will compute the tax liability in different situations. Now let's understand the concept of marginal relief with an example. As we have learned that marginal relief is available for the assessee whose income is exceeding the limit for application of surcharge marginally. That means because of additional income of very small amount, the increase in tax liability is very high as compared to increase in income, and therefore the marginal relief is given by Indian Tax Department to the assessees. Now how exactly that marginal relief is computed, let us see with the help of one example. Compute tax liability for an Indian company ABC Limited who is having income of rupees 1 crore 1 lakh. Now here we will consider two different scenarios when the income of the company is 1 crore, and in given case when the income of ABC Limited is 1 crore 1 lakh. Now why we are comparing these two scenarios is because at 1 crore level of income the surcharge is not applicable, and as the income exceeds 1 crore then the surcharge is applicable. So as we can see here that if the income in first case is 1 crore, then you will apply tax at the rate of 30%, so which is 30 lakhs. Surcharge is nil, so total tax including surcharge is 30 lakhs. Now if we compare this situation with the case of ABC Limited whose income is 1 crore 1 lakh, as you can see in second column, this company will be paying tax at the rate of 30% on the income. So 1 crore 1 lakh into 30% will give us 30 lakh 30,000 as the tax payable. Now in this the company is required to add surcharge at the rate of 7% because the income is between 1 crore to 10 crores. So on 30 lakh 30,000 you will apply surcharge at the rate of 7%, so which will give us 2 lakh 12,100. So once we add both of them, that is 30 lakh 30,000 plus 2 lakh 12,100 will give us the total tax including surcharge of 32 lakh 42,100 rupees. Now if we compare at this level, that if we compare first case and this case, then there is an additional income of rupees only 1 lakh. As you can see the difference is just rupees 1 lakh. As you can see the difference is just rupees 1 lakh. That is additional income of 1 lakh. And as compared to that, the addition of tax, see at the level of 1 crore income the tax is 30 lakh, and as the income becomes 1 crore 1 lakh, for that extra 1 lakh rupees the increase in tax liability is 2 lakh 42,100. So you can compare this thing, that additional income of 1 lakh for which you are going to pay additional taxes of 2,42,100. Now this is not justifiable. That means assessee is in short incurring a loss for the additional income, and for that purpose income tax says we will allow you the marginal relief to the extent of the difference between additional income and additional tax liability. Because what the maximum burden can be borne by the person is to the extent of additional income. To that extent assessee can get ready to pay the tax liability. That means if the income is exceeding 1 crore by 1 lakh, then maximum extra 1 lakh rupees tax will be borne by the person, and therefore you will give the relief of 2,42,100 minus 1 lakh. So the relief amount is 1,42,100. As you can see, in first case there is no concept of relief because there is no surcharge, but in second situation the relief is available. But this relief will be available only when the differential income is less than differential taxes. Only in that situation the relief should be available. So relief is 1,42,100. So once we reduce from 32,42,100 rupees 1,42,100, then the balance amount or balance portion would be treated as 31 lakhs. On this 31 lakhs, you are supposed to calculate education cess at the rate of 3%, which is 93,000. So the total tax payable by the assessee company is rupees 31,93,000.